Hey, good day, everyone. Welcome to our webinar. We're going to get started in a couple of minutes. I'm a little bit early because a lot of you cannot come into the webinar until I actually start broadcasting. So again, thanks so much for joining us. We're getting more and more people, as I see now, joining our webinar. This is going to be a short webinar. Usually webinar take anywhere between 45 minutes and an hour, but this is going to be less than 30 minutes. Obviously, it's going to be very short, but it's going to be a brilliant webinar because I do have a lot of information to share with all of you when it comes to tax planning in the 21st century. So please continue to log in. I would appreciate if you have a cell phone that you can turn it off. If you want to write some notes, you're welcome to do that. We're definitely going to have a good time. Just want to welcome everyone. For those of you that may be joining me for the first time, we do webinars every week. I also have a podcast channel, which is called Your Tax-Free Life podcast. So you're able to find it on YouTube or wherever it is. If you happen to have an iPhone, you should have an app that's called podcast, and then you can search for your YouTube, your tax-free life. And then once you find it, I would appreciate if you can subscribe, because on a weekly basis, we do a podcast regarding a financial topic. I think I've done 71 podcasts, so it's been going for a while. We're one of the best podcasters out there, one of the best podcasts that there is in the marketplace in the area of financial services. So you're going to get a lot of good information along those lines. I also provide a webcast to the vast majority of you, and through my clients. Also, you can go online on Facebook, and you can find me in a couple of different areas. One is Tax-Free Retirement Life Facebook channel. And also my accounting firm, which is Gable's Tax Planning Group. You can also find me there. And then you can join us, and obviously you're going to receive a lot of information that is going to be very, very important for most of you. We're getting more and more people logging in. This webinar is supposed to start in another minute at 6:30. And obviously for those of you that are joining us, I don't want to keep you waiting, so as soon as it hits 6:30, then we'll start the webinar. And again, I'm excited to be here with all of you. My number one goal for all of the workshops and the seminars that we do and the webinars that we do and the podcast, is to kind of help all of you change the way that you see things. Because when you change the way that you see things, the things that you see change. So I'm hoping that you're going to get a lot of good feedback out of this webinar. And I guess we can get started at this point in time. Let me go ahead and share my screen with all of you so I can take you to the PowerPoint presentation, which is the one that I'm going to be sharing with all of you tonight. And we're here. And all right, I think we're here. I think that you can all see my my desktop. So we're ready to go. Again, thanks very much for joining me today. My name is Bert Salazar, and I am going to be your host for this webinar. For those of you that don't know how I am, I've been in the financial services industry for almost 30 years. So my firm specializes in tax planning, insurance, and alternative investments. So obviously we just finished tax season. We had a very strong tax season. And it's always very interesting because, whenever we have tax season, we have a lot of our clients coming into us. Many of our clients, we do it through the web. So we're able to do all their tax planning through the web. And under the firm that does the accounting, which is Gable's Tax Planning Group, not only do we do tax preparation, bookkeeping, and payroll services, but we also do tax planning, which is very, very critical for the vast majority of you and for many of the business owners that we deal with. So obviously today the webinar is going to be based on the importance of tax planning in the 21st century. And I tell you this from many different ways. Obviously, there's a major report that I just finished reading that was published last week, which is the Congressional Budget Office report that comes out once a year to give the status of the US government and the national debt and the revenues and the expenses and the different programs that are available in the United States and the viability of those programs when it comes to tax planning and the economy and the future of the United States of America. So this information is going to be very critical to all of you. What I am going to share with you is I'm going to share with you a lot of the problems. In other words, if you don't understand the problem, then you're never going to bother with the solution. So what I'm going to be sharing with you are some of the major numbers that just came out of, and I'm just going to walk you through the highlights, because this report that I read over the weekend had 272 pages. So obviously, I just took some of the highlights because I feel that if you understand the highlights and if you understand the problem that we're having in this country today, then it's going to give you the ability to plan for the future and make sure that you have total control of the future as opposed to allowing anyone else to control it on your behalf. Now, obviously, some of you may be doing okay. Some of you may be doing better than others. You know, when it comes to your investments, your retirement planning, your careers, and so forth. But what I can tell you is the following. Even a broken clock is right twice a day. And what I mean by that is that, you know, most of the clients that I engage for the first time, or most of the clients that I engage after, you know, they come in to see me for tax planning purposes, you know, after I review all the stuff that they've done, whether they've done it with someone else or they've done it by themselves, you know, one of the questions that I do ask them is, you know, are you a fool or are you being foolish? And the reason for that is that unless you live in a bubble, unless you have lived in the jungle for the last 20 years, if you don't understand what's going to happen in the United States in the next 7 to 10 years, and if you don't plan accordingly, then chances are, you know, you're being foolish or you're basically a fool. So what I'm going to try to do today is kind of open up your world, get you to see things, and get you to understand things from a different perspective, because at the end of the day, most of the decisions that all of you have made in the past, you have made those decisions through a microscope. The way that I like to work with my clients and the way that I like to promote a lot of this education that I do for all of you is to help you take a look at your financial affairs and your financial decisions through a telescope as opposed to a microscope. The view is going to be totally different. So obviously, the name of this webinar is, you know, the importance of tax planning in the 21st century. And for those of you that stay till the end of the webinar, by the way, the webinar is going to be fairly short. I am going to send you, and I'm going to ask you to send me an email so I can get your email address. And then I'm going to send you a white paper that I wrote almost a year ago, which is called How to Create a Tax-Free Retirement Life. And that white paper is going to walk you through all the steps that all of you need to take if you're interested in having a tax-free retirement life. If you're not interested in tax planning, then obviously you might as well shut off your computer today, and let's not move any further, because at this point in time, this webinar is not going to be apropos to all of you. So by the same token, after this webinar, if you're interested in engaging us in some kind of a private consultation, confidential consultation, then you're going to have the ability to do so. These private consultations that we do after each and every webinar is done totally free. There's no cost. There's no obligation on your part. And you're going to have the ability to discuss specific issues and concerns that you may have regarding your finances, and at least get a second or a third opinion regarding that matter. So with that being said, let's get into the webinar and let's talk a little bit about the facts. Number one was something that you obviously see in the media all the time, quite a bit now, is that, you know, the 2019 national debt is now sitting at $22.3 trillion. And that's trillion with a T. We have never had this much debt in the history of our entire country. So if that doesn't bother you, nothing else will. But let's make it a little bit more interesting. The 2019 unfunded liabilities are now sitting at $123 $0.6 trillion. Almost $124 trillion. Now, the question you may ask is, Bert, what's the definition of an unfunded liability? Well, the definition of an unfunded liability is basically all of those promises that the US government has made to all of us that they don't have the money to pay and be able to keep up today. So what are those promises? Well, Social Security, Medicare, Medicaid, Medicare Part D, and the interest on the national debt. That all amounts, all of those liabilities amount to almost $124 trillion, and that's money that we don't have available today in order to pay. The total assets for the United States of America as of 2018, by the way, this is all part of the highlights that I'm covering with you that just came out. This report just came out last week, and it was for 2018. Is sitting the national assets, the total value of all the assets that we have in this country is sitting at 137 trillion. So we are a very wealthy country, but we have a tremendous amount of debt. We're getting to the point that we're becoming another Greece from a debt perspective. Now, something that is very important for all of you to understand, and this is something that is critical for us in the accounting world to be able to understand that way as well, is that, you know, there are, if you're an accountant, obviously you understand that there are general accepted accounting principles, what we call GAAP, and those are the accounting principles that I have to abide by when I do accounting for my business clients. You know, my business clients, I have to do a profit and loss statement for them. I have to do a balance sheet. I sit down with my business clients and we do a review of their P&L statements, a profit and loss statement, and their balance sheets on a quarterly basis. And it's important to do that because it's giving them a flavor of what the business is doing on a quarter by quarter basis. Now, we also have something called the fiscal gap. And the fiscal gap is one that you don't hear so many people talking about. And traditionally, that's because they don't understand what it is. But basically, the fiscal gap is that all those unfunded liabilities that I just talked to you about, that in a traditional business and in a traditional country, other than the United States of America, would have to go on the balance sheet. For instance, if you own a small business here in Florida, and you have a business, you have a P&L statement, you have a balance sheet. You have assets, you have liabilities, and then you have the shareholders' equity, and they all need to balance. Well, the unfunded liabilities for the United States of America, that $124 trillion that I've been talking about, should be on the balance sheet, except that the US government has made a decision to keep those numbers out of the balance sheet. No other country in the world would do that. And obviously, the IRS would not allow any company in the United States to do that as well. So that gives you a flavor of how big the problem is. And again, today I'm just giving you the facts. Another fact is that, you know, what are the future tax rates probabilities? You know, there's a very high probability that taxes in the United States, especially over the next 7 to 10 years, are going to have to double, or our country's going to go bankrupt. I don't know if you guys have heard about David Walker. David Walker was the Comptroller General of the United States, pretty much the accountant of the United States. And he was also the head of the Government Accountability Office for the US government. And he was there under Clinton and Bush. So he was there from 1998 until 2008. He is probably the #1 economist in the United States and one of the top economists in the world. And he basically said the same thing. He says, unless we make certain decisions today, taxes are going to have to double in order for us to be able to pay for all these liabilities that we have. And if we don't do that, our country's going to go bankrupt. Now, let me address a little bit of the additional financial reporting highlights that I thought would be important to all of you, because at the end of the day, I want you to understand how critical the situation, the tax situation is in the United States, and understanding that there's a tax train coming down the tracks. And most of you, and most Americans, are sitting in the middle of the track. You're hearing the noise, but you're not doing anything about it. And unless you do something about it, that train track is going to run you over, and it's going to destroy your life, your financial life, your retirement life, and that of your family for many, many years to come. Now, when you take a look at the federal deficit, that's pretty much the amount of revenues that we bring in as a country every single year. You know, the interest that we generate on our investments, the taxes that we collect, because those are pretty much the only things that the government can do in order to bring revenue to themselves. And then obviously you have the expenditures. So you take, you know, what you're bringing in and what you're spending out. We are at a deficit right now equal to $779 billion. That's an enormous deficit. And by 2020, that deficit is going to be $1 trillion. That means that we're bringing anywhere from $3 to $3.5 trillion of income every year, but we're spending, you know, so much more than that when it comes to the debt that we have in this country. And for that reason, and that reason only, our debt to liability ratio is going to go through the roof. So again, we're bringing in about $3.5 billion a year, but we're spending north of that, and we have $79 billion deficit. The other thing is that, you know, according to all of these reports, not only the 2018 financial report, the CBO report, and the GAO projections, it shows that absent any policy changes, our debt to GDP ratio is unsustainable. That means the debt that we have in this country to the gross domestic product is unsustainable. So therefore, the US government is going to be forced to make decisions in the very near future that is going to impact all of your lives for many, many years to come. Now, Social Security spending is surpassing now $1 trillion starting in 2019. So we're paying out through Social Security benefits $1 trillion because of the fact that 10,000 baby boomers are retiring every single year, and they will do so at least for the next 15 to 20 years. So that's a major, major impact on Social Security in this country and the benefits that they pay out. Pension Benefits Guaranty Corporation will be depleted by 2025. If you work for a private company or you work in the public sector, obviously you have seen, you know, some pension systems have gone bankrupt. Some of the airlines' pension systems have gone bankrupt. When a pension system goes bankrupt, they get taken over by the PBGC, which is the Pension Benefit Guaranty Corporation. But the problem is that when that pension system goes down, you know, most of the employees under that pension system may receive anywhere between 25 cents on the dollar that they were promised. So they're receiving a lot less money than what they were promised by the pension system when they started to work for that system and or that company. The problem now is that Pension Benefits Guaranty Corporation will be totally depleted by 2025. And by the way, we're in 2019, so that's 6 years from now. That's another major problem. Medicare, Medicaid, the spending is going to surpass $1 trillion a year for each starting in 2026. So it'll be $1 trillion in expenditures for Medicare, $1 trillion for Medicaid. Now the states get involved in the Medicaid side of the house, but by the same token, that is $1 trillion per year for Medicare and $1 trillion per year for Medicaid as well. Medicare Hospital Insurance Trust is something that we deal with on a regular basis whenever, you know, you apply for Medicare and now you're age 65 or older, will be depleted by 2026. What does that mean? Simply speaking, that there will only be sufficient money there to cover 91% of all hospital-related medical expenses. And every year after that, that number is going to be lowering and lowering and lowering to the point that it's going to disappear until, again, Congress decides to do something about it. Defense, the annual spending, it will be at $771 billion by 2029. So that's a tremendous amount of money that we spent the fact that we want to maintain strength not only in the Western Hemisphere, but throughout the world. So we have to be able to spend that kind of money. National debt net interest will be hitting $1 trillion by 2030. See, one of the advantages that we have had over the last 12 years is the fact that because interest rates are so low, the amount of money that it takes to service that national debt that I gave you at the very beginning, of $22.3 trillion, hasn't been that much. It's been like 250 to 300 billion. But by 2030, especially now that interest rates are starting to rise, and the higher the interest rates go up, the more expensive it's going to become for us to service that debt. So it will go in 2030 to $1 trillion. I remember when I was growing up in this country, the debt was in the millions, and then as I got a little bit older, it got into the billions. Today we're talking about trillions and trillions of dollars, just like if it was nothing. Nobody truly understands what $1 trillion truly is unless you deal in this every single day. Social Security Trust Fund, and this is a major one for all of you listening to this webinar. Social Security Trust Fund is going to be depleted by 2034. That means that after 2034, we're only going to be able to pay 77 cents out of every dollar, and then it's going to get worse and worse. The challenge that we have with politicians in this country, and I don't care which side of the aisle you come from, is that politicians are very good at selling, but they're not very good at truly making sound financial decisions for the betterment of Americans in the United States. They're only there for themselves for the most part, and they want to keep kicking that can down the road. And you can only kick the can so much until the can is going to come back and start kicking you back. So now between 2026 and 2034, the multiple cans are going to start kicking back at us, and we're not going to be able to do anything about it unless we start doing something about it today. Now, obviously, whenever we get into a conversation, I'm hoping that, although I've given you a lot of the bad news, by the same token, I want to start helping you understand, what it is that you can do today in order to minimize and or limit your exposure to all of these taxes that are going to be coming down the pike, because the only way that the government is going to be able to pay for all these things is either reduce the benefits, get people to retire longer before they can start paying benefits, or start increasing taxes. Now, nobody wants to reduce benefits. At least politicians do not want to talk about reducing benefits and or forcing people to retire later in life. So obviously, they're going to do the easy way out, which is they're going to start raising taxes along those lines. Now, we do have a 7-year window. For those of you that know this, and I'm sure most of you do, President Trump signed into law in December of 2017 the TCJA. The TCJA starts for the Tax Cuts and Jobs Act, which took effect January 1 of 2018. Now, the good thing about the TCJA is that, number one, your deductions went up, and your tax brackets went down. So for the vast majority of Americans, especially middle-class Americans, contrary to what politicians will tell you, most middle-class Americans actually received a tax break in 2018, which was the first year under the Tax Cuts and Jobs Act. Believe me, I'm a tax planner, so I do tax preparation for many of my clients, and the vast majority of my clients experienced major tax benefits in 2018. The problem with the Tax Cuts and Jobs Act is that it's going to end. It will sunset December 31st of 2025. So when all of us wake up January 1 of 2026, we're going to be finding ourselves under the old tax law, which the standard deductions were lower and the tax brackets were higher. But if you think that 2026 is going to be bad from a taxable standpoint, what's going to happen 2027, 2028, 2029, 2030? Taxes are going to have to almost double, if not double, or our country's going to go bankrupt. So from a taxable perspective, here's how you need to look at your financial world. There are three IRS tax buckets that all of you need to be aware of. You have the taxable bucket, as you see there, you have the tax deferred bucket, and then you have your tax-free bucket. The taxable bucket is primarily your money market accounts, your savings accounts, your CDs, if you have traditional mutual funds. And the reason why you know it is a taxable bucket is that every year you're going to receive a love letter from the institution where you have your money in, which is called a 1099, and you're going to have to report that for tax purposes. Now, obviously, it's important to have it there as well, and we'll talk a little bit about that, but you should never have more than 6 months of emergency funds and opportunity expenses in the taxable bucket. Now, the tax deferred bucket is the bucket that most of you understand. This is where you have all your qualified plans. This is where you have your pensions. This is where you have your IRAs, your 401ks, your 403bs, your deferred compensation programs. There are many of them. I didn't want to name them all, so I named them qualified plans. And there, what happens is the money that you put in is pre-tax. The money grows tax deferred, but then when you retire, you have to pay taxes not only on the contributions, but also on the growth of that money. And then last but not least, you have your tax-free bucket. And the tax-free bucket is comprised of municipal bonds, and there's an asterisk there on municipal bonds, and I'll share what it is in the next few minutes. You also have your Roth IRAs, you have your Roth 401ks, and last but not least, you have your 7702 plans, which are your cash value life insurance plans that all of us should be using as a supplemental retirement vehicle because of all the benefits and tax features that this tax-free bucket offers under the IRS code. Now, the challenge that I have whenever I do a tax audit for any clients, whether it's a new client or a client that comes in from a tax planning standpoint, is that the vast majority of the money that most of you probably have today, it's in the taxable bucket and the tax deferred bucket. So if taxes are to double in the next 7 to 10 years, or if they go up by 20, 30% in the next 7 to 10 years, the vast majority of the assets that you have are going to be fully taxable in retirement, and that's going to create a major problem not only for you, but also for your retirement life and for your family. So you got to learn how to start shifting a lot of your money from the taxable and tax deferred bucket to the tax-free bucket, and I'll talk about that in the next few minutes. Now, the next thing is I get questions often, what is taxable income? Well, income can be received, just so you get a feel for what taxable income is. It can be received in a number of ways, actually 3 ways. Could be money, services, or property. Now, there are 2 types of income that all of you should be receiving or are receiving on a regular basis. It would be earned income or unearned income. So you have earned income that you work for, and then unearned income, which is your money working for you. So examples of earned taxable income would be your wages, salaries, tips, commissions, fringe benefits that you may get from your employer. And obviously your unearned taxable income, it's pretty wide range. You have unemployment benefits. So therefore you're unemployed, you're not working, but you're collecting benefits. So that is considered to be an unearned taxable income. Lottery winnings, if you happen to be a lucky one. Profits from asset sales, so if you sell a piece of property or you sell a stock or you sell a bond, that's going to be unearned income that is going to be taxable to you. Alimony payments, and we'll talk a little bit more about that. Social Security and Medicare income. So if you're receiving Social Security and Medicare income that is being paid by your employer, that's also taxable to you as well. Social Security retirement income. Most of you think that when you retire, you're not going to pay taxes on your Social Security benefits. Well, unless you've done proper tax planning, there's a very high probability that up to 85% of your Social Security benefits will be taxable in retirement. And doesn't that feel like a double tax? Because you have to pay a tax to put money into Social Security, and then you're being taxed on the way out. So I'll explain how that works toward the end of this short webinar. And what else? Rental income. You know, if you have a piece of property that you have rented out, or you own a small apartment building or a building, any income that is coming in from that source is going to be unearned taxable income to you and your family. Capital gains and losses, stock dividends, bonuses and rewards that you may get from your employer. Pension income. You know, I have a lot of clients who are public employees and they're retired, so that pension income, 100% of that pension income is being taxed to them. IRA income, so if you have monies in your tax deferred bucket when you pull the money out, IRA income, 401k income, 403b monies that are coming out, deferred compensation program monies that are coming out to you if you happen to be a public safety employee will also be taxable, unearned taxable income to you. And then obviously other pension benefits that we're not going to get into. Now the big question to all of you is, well, you know, if all of those things are taxable income, and they could be, it could be earned income because I'm working for it at the point in time that is being paid to me, or unearned income because now is my money or my property's working on my behalf, then what is non-taxable income? And it's important that you understand this, because if you understand the problem and then you understand the rules of engagement under the IRS code, then you're going to have a great ability to maximize your internal rate of return in the future when it comes to retirement distribution planning. Now, most non-taxable income, while not taxable, must be included in your tax return. Most, not all, but the vast majority of non-taxable income, you still have to show it on your 1040 and your tax return when you file. Now, what are some of the examples of non-taxable income? Again, just like unearned income, there are a lot of them. You know, cash gifts, inheritance, cash rebates from retailers that you do business with, welfare income. Now, obviously, if you're receiving welfare, it means that you are not doing very well financially. So therefore, the government is not going to charge you taxes on that income on top of that. Damages that you receive from injuries. If you have a car accident or illnesses or disability, so let's say that you have a major car accident and now you become disabled, or you lose a limb and you file a lawsuit and you're collecting certain damages, those are not going to be taxable to you. Child support payments are not taxable either. Alimony payments, remember we talked under unearned taxable income, alimony payments, that is there and it is correct. But now alimony payments that are based on a divorce decree that happened or was finalized after 2018, then will no longer be taxable. So if you got a divorce prior to 2018, then your alimony payments are going to be taxable. If you got a divorce after 2018, then those payments will not be taxable to you. And that's because of the Tax Cuts and Jobs Act that President Trump signed into law back in 2017. Employer reimbursed expenses. So, you know, if you're doing something for your employer, and let's say you're driving an automobile or you're spending money of your own and you're getting reimbursed for that, well, they're actually reimbursing you out of your own expenses. So therefore, they're replenishing the money that you had, that you used to fund that expense for the employer. So obviously, that money coming back to you is not taxable from that perspective. Life insurance death benefit proceeds. So if you happen to die and you have $1 million death benefit, your beneficiaries are going to be receiving that money federal income tax free. Retirement income. If you're receiving retirement income from the tax-free bucket, like Roth IRAs, Roth 401ks, and properly structured 7702 plans, that is all tax-free income. So I don't care if you're generating $200,000, $300,000 a year. If all that income is coming in from your tax-free bucket, then you pay no federal income taxes. You don't even pay taxes on your Social Security benefits. So you're able to maximize the internal rate of return in your retirement just by understanding how the tax laws work when it comes to retirement distribution plan. Now, what are some of the things that you can do to mitigate tax increases in the future, not only now, but for many, many years to come. Well, let me give you some examples. Number one, you should have an adequate balance between the taxable, tax-deferred, and tax-free bucket. Now, if taxes are going to go higher in the future, remember, when you put money away in your tax-deferred bucket, like your IRAs, your 401ks, and your pension, you're actually not saving money on taxes. What you're doing is you're deferring the tax. And when you defer the tax, you're also deferring the tax liability. And the tax liability will be based on the year that you're going to start taking the money out and what tax bracket you're going to find yourself in and what tax brackets have the US government and the IRS declared at that point in time that now you're going to have to abide by. So those of you that have been putting a lot of money away in your 401ks and your IRAs, you better start doing some tax planning because you may end up in a higher tax bracket in the future than you are today. So if you're going to be paying taxes on that money at a higher level, then why did you put it there to begin with? So obviously there's a right balance and you need to have some. I'm not saying that you should not have money in your tax deferred bucket, but there's an optimum number that you need to do, you need to have there. And then that depends on your individual situation. So if you want to have a confidential private consultation with me at no cost or obligation, I'll be more than happy to review all of those statements with you and give you some feedback as to the things that you need to do in order to minimize your tax liability in retirement. Now, you also need to maximize your itemized deductions. So mortgage interest, healthcare expenses, property taxes, charitable deductions that you may be making, investment interest expenses that you may not be claiming on your tax return because you have forgotten about them. Business expenses, what if you own a business? There are many, many different things that you can do to deduct business expenses if you own a corporation like I do. I own 3 of them. Or if you happen to be self-employed, there are a lot of things that you can do from a business standpoint and from a taxable perspective. Carry forward losses, to offset capital gains. So if you had a year where you had losses in a stock account or you sold a piece of property at a loss, well, in the years that you have a capital gain, then you can carry the capital losses and offset capital gains and capital losses. What most of you are going to find when you get to retirement is that many of those deductions that you were able to take while you were employed, you're probably going to lose, because by the time that you retire, either your mortgage is going to be paid for or you're going to owe very little. So the vast majority of the mortgage payments that you're going to be making on an annual basis will go toward principal. So therefore, your deduction for the mortgage interest is going to be minimal. Your kids are out of the house if you have children, hopefully. So therefore, and even if they're not out of the house, you're not going to be able to take a deduction for them. Obviously, if you're no longer employed, you're not making contributions to your IRAs and your 401ks. So therefore, you're not going to be able to deduct that. And most important, if you were making charitable contributions to the charity of your choice while you were employed, what I have found is when people retire, then they start shifting from making charitable donations and contributions to actually giving more of their time. And just so you know, the IRS doesn't care how much time you give to a charitable organization, you cannot deduct your time. By the way, inflation is not tax deductible either, so it's something important that you need to keep an eye on. Now, when you do your taxes on an annual basis, and according to the IRS and some of the reports that I read for the 2018 tax season, only about 20 to 25% of Americans actually itemized their deductions in 2018. And the reason for that is that if you were married filing jointly prior to 2018, the standard deduction was $12,000 and change, $12,700 to be exact. But in 2018, it went from $12,700 to $24,000. So that means that a lot of Americans no longer needed to itemize, because when you add all of the itemized deductions, if they don't amount to at least $24,000 if you're married and filing jointly, then you are definitely going to take the standard deductions. Now, if you have high mortgages and you have a lot of expenses that are deductible and your itemized deduction then exceeds the $24,000 for a married couple filing jointly, then obviously you need to take the itemized deduction because it is the higher number. But you know, for most Americans, you will find that at least for 75% to 80% of them, the standard deduction is going to be the ideal deduction for them. Now, you also need to maximize your capital gains tax annually. And the reason for that is that capital gains are taxed at a lower rate. So that means if you hold a stock or a piece of property for at least a year and 1 day, then obviously when you sell it, instead of having to pay ordinary income taxes, you're going to be paying a capital gains rate, which is always lower than ordinary income taxes. So you have to be able to start thinking for your retirement planning to start putting more money away, not only into the tax-free bucket, but also in buckets that will generate capital gains taxation as opposed to ordinary income taxation. Increase annual contributions to your tax-free bucket, and there are many different ways that you can do it. You can make contributions, start shifting some of the contributions that you make to your 401k to a Roth 401k or to a Roth IRA. If you have a traditional IRA or a traditional 401k, perhaps you start thinking about doing some Roth conversions along those lines. And obviously, I walk you through all that in my white paper. If you're interested in learning more about it, obviously, you can send me an email at the end of this webinar, and I'll be more than happy to send you that white paper so you can read it. And then if you have any questions, you can feel free to reach out to me at that point in time. So, but at the end of the day, the more money that you have in your tax-free bucket, the better off you're going to be. So there's a maximum that you need to have in the taxable bucket, and there's an optimum that you need to have in the tax-deferred bucket. Everything else should be in the tax-free bucket from a business perspective. Provisional income calculations. These are the calculations that you will have to do, or your accountant is going to have to do for you. I do those calculations for my clients every single year, and they will determine the adequate levels of the taxable and the tax-deferred bucket that you should have. So if you have just the right amounts of money in the taxable and the tax-deferred bucket, you can actually get away with murder, and I'll explain that to you in the next couple of minutes. So now let's talk a little bit about provisional income calculation. Provisional income calculation comes into play at that point in time where you're going to start to receive your Social Security benefits and you're going to retire. And basically, when you look at provisional income calculations, this is the calculation that we do, and I do these for my clients all the time, in which we take on a given year. So let's say I did provisional income calculations for the vast majority of my clients that were retired in 2018. So I had to do a provisional income calculation for them in order to determine what percentage of their Social Security benefits was going to be taxed in retirement. If you do a good job, it should be zero, so you should not have to pay a single dollar on your Social Security benefits. If you do a not so good job, up to 50% of your Social Security benefits will be taxable. If you do a lousy job, up to 85% of your Social Security benefits will be taxable in retirement. And that's a difference between being a fool or doing foolish things. And by the way, if the only income that you had coming to you in your life was a Social Security benefit income, then you wouldn't have to pay taxes on those Social Security benefits. So the taxation of the Social Security benefits is not based on the Social Security benefits themselves, but it is based on all the other income that you have coming to you for that year. In this case, we just went through the 2018 tax season that will determine what percentage of your Social Security benefits may be taxable to you. Now, what goes into the calculation? Well, when I do the calculations for 2018, I take 50% of the Social Security benefits that was paid out to my family, whether someone that files single or married filing jointly, I take 50% of that benefit. Then to that, I add the ordinary income that they received throughout 2018. So any wages, any pensions, any 401k distributions, any IRA distributions, all of those form part, because they're being taxed as ordinary income, they get added on to the provisional income calculation. Then I take dividends and capital gains. So any dividends that you received from any stocks, any mutual funds, any capital gains because you sold a piece of property or stock or a bond in 2018 will actually get added on as well to the provisional income calculation. And then last but not least, non-taxable income. And remember when I went through the 3 buckets, that under the tax-free bucket, I mentioned municipal bond funds, and I had an asterisk on top of it. Well, this is where the asterisk comes. Although municipal bond funds are free from federal income taxes, they may not be free from state income taxes, but that income that you generate from a municipal bond fund will get added on to the provisional income calculation to fully determine if your Social Security benefits are taxable or not. So although municipal bond funds are received federal income tax-free, they're not truly tax exempt because they can have a negative impact on your Social Security benefits and/or Medicare premiums in retirement as well. There are only 3 vehicles under the IRS code, and we'll cover those in the next couple of minutes, that are totally tax exempt from Social Security taxation, from capital gains taxation, from ordinary income taxation, and obviously if you're able to do that and to fill your tax-free bucket with as much tax-free income as possible, the better off you and your family are going to be for the future and for many years to come. Now, what are the 4 tax-exempt retirement vehicles? Obviously, I already mentioned the Roth IRAs, the Roth 401ks, the 7702 plans, which are the cash value life insurance plans. You see, in a Roth IRA, you can only put so much money. In a Roth 401k, you can only put so much money. So a lot of my clients that have the ability to put and they generate a lot of revenues and have the ability to put a lot of money away for retirement, they use cash value life insurance or 7702 plans in which we earmark those just for retirement distribution planning. So instead of putting the least amount of money and buying the highest death benefit possible, we do it the other way around. We buy the least amount of death benefit and we put the most amount of money possible because we want the cash balance in those accounts to grow substantially and to grow quite rapidly. And then the 4th vehicle there, this is one that you've never heard of, is what I call a leveraged qualified plan. See, I've been telling you that in the tax-deferred bucket, you need to have an optimum amount. And if you have the optimum amount of money in the tax-deferred bucket, let's say a 401k or an IRA, where the money went in pre-tax, the money grew tax-deferred, but then traditionally when you pull the money out, you have to pay taxes on the whole thing. If you do proper provisional income calculations, you can actually pull money out of the tax-deferred bucket, IRAs and 401ks, and if you pull the right amount under the right circumstances and you have the proper tax hedging strategy in place, then you can actually pull the money out and do a tax offset and not have to pay a single dollar federal income tax. So when it comes to tax planning in the future, and there's a 7-year window, guys, so therefore, if you're gonna do any tax planning, you have to start today. And you have to maximize anything that you're gonna do from a taxable perspective between now and December 31st of 2025, because after that, it will be open season, open game, tax rates are gonna go through the roof, and if you haven't done your due diligence, then you are a fool. I'll tell you straight up. So if you have the ability to maximize your Roth IRAs, your Roth 401ks, your 7702 plans, and your leverage qualified plans, then you're going to be sitting in a much, much better position than you would have been otherwise. Remember that there are only 3 types of people in the world. Those that make things happen, those that watch things happen, and then those that just say and wonder what happened. So you don't want to be on that group that just wonder what happened, because it'll be too late. You're still on the track and the train just ran by you. And obviously your life is going to be totally different and is going to be in a really, really bad situation, not only for you, but also for your family. So what is the golden rule when it comes to tax planning and retirement distribution planning? Number one, the golden rule basically says that he who has the gold makes the rules. So who has the gold? Well, the U.S. government has the rules. So unless you're able to take those rules and apply them to yourself and be able to maximize the internal rate of return on everything that you do from a taxable perspective, then you're basically going to allow the government to control that tax liability. Remember, if you don't manage it yourself, the government is going to manage it for you, because they do have the ability to do that, and they do every single day of the week. Now, always remember that there's a major difference between tax avoidance and tax evasion. I'm an accountant, so I do tax planning for my clients every single day. So you have to maximize all of your tax deductions, but by the same token, you have to make certain that you don't do anything wrong. So, whenever I do any tax planning, whether you're an individual that needs my help in doing tax planning for the future, or you happen to be a business owner, then we're going to review and do audits on a number of things that are going to help you determine what is the best way to do, and what are the financial decisions that you need to make through a telescope as opposed to a microscope. Taxes will more than likely double in the near future, and that's something that all of you are going to have to deal with. All of us are going to have to deal with. Now, I have been doing tax planning for the last 15 years in my business, not only for me personally, but also for my practice, so I'm well on my way there. But many of you have not done any tax planning. You're just sitting on the sidelines watching that parade go by. Tax efficiency will create a more reliable retirement. Again, for you, your family, your business, you're going to be able to do more with your money than you could have ever imagined, because of the fact that you've done it the right way. And then obviously, think of it this way: we're living historic high. We have historic high debt in this country, and we have historic low taxes. So we all know that it's almost impossible for us to reduce the debt, but we can definitely raise the taxes in order to offset, the servicing of that debt. So just if you use common sense, and I know that common sense is the least common of all senses, but at the end of the day, if we have the most amount of debt that we have had in our country, and one of the lowest historic tax rates, where do you think that ratio is going to go to in the next 7 to 10 years? And the sooner the government gets to do this, the better it's going to be. Now, who knows who's going to win the election in 2020? Obviously, the tax cuts are going to be there until December 31st of 2025. But after that, it will be a free-for-all. And obviously, if you're not prepared, you're going to pay the price dearly. And obviously, as I've said many a times, and I keep saying, the Tax Cuts and Jobs Act will sunset December 31st, 2025. So you must do your due diligence, and you have a 7-year window in which to enhance all of your probabilities and capabilities along those lines. So my call to action to all of you, if you want to engage us, we would have the ability to do a tactical retirement blueprint for those of you that are interested in doing that. What does that comprise? Well, number one, we will do a tax return efficiency audit. So we're going to be reviewing the tax return for the past 2 years. I can assure you, whenever I do a tax planning calculation for a client, I don't care how good your tax preparer was. I always find ways to reduce tax liabilities, not only for those years where you may have already filed your taxes and you may have to amend your tax return, but also we do tax forward planning to make certain that we minimize the impact of taxes in the future for you and for your family as well. This same report will also contain a Social Security report. This Social Security report will actually let you know the optimum time for you to start taking Social Security benefits, and most important, what would be the tax optimum time for you to access those benefits as well. The third report that comes as part of our tactical retirement blueprint is a retirement distribution audit report. You see, when it comes to retirement, not all income is created equal. So remember, as you're putting money away for retirement, you're worried about the accumulation rate. When it comes to retirement distribution, you worry about the distribution rate. So the rules of engagement totally change from accumulation to distribution. But because of the fact that the vast majority of Americans, when they retired, they have spent 30, 35, 40, 45, 50 years of their lives on the accumulation stage, they feel that the rules of engagement for accumulation are the same for distribution, and it is totally the opposite. And unless you do proper tax planning, there's a very high probability that you're going to leave a lot of money on the table for nothing. And last but not least, the Tactical Retirement Blueprint will also include a Tactical Retirement Asset Shifting Report. This is where we now start to shift, and we do this on an biannual basis. We start shifting money from the taxable and the tax-deferred bucket to the tax-free bucket, but we do it in a way that it doesn't negatively impact your tax liability in those years as you move forward into your retirement sunset. For those of you that may want to reach out to me, feel free to contact us. You may obviously call me at area code 786-766-1042. Let me repeat that once again, 786-766-1042. If you don't have a piece of paper and you're interested in reaching out, take your iPhone and take a picture of this slide here so you can have it there, and then obviously you can contact me. If you want to send me an email because you're interested in having me send you that how to create a tax-free retirement life white paper, then obviously go right ahead and send me an email at Bert, B-E-R-T, at gablestaxgroup.com, or you can also email me at Bert, B-E-R-T, at bertsalazar.com, and I will be more than happy to go ahead and send that report to you. Let me go ahead and stop sharing right now because I do think that some of you may have already sent a message requesting the report. Let me check. Some of you may be having some questions here. Okay, Louis. Oh, thank you, Louis. Very good. Thank you so very much. I'm hoping that many of you, yes, I'm getting now many of you that want the report. So please feel free to send me an email, and I'll make that report available to you again. Just to close it out today, number one, I can't thank you enough for giving me a few minutes of your time, because I know all of you are very important. Some of you need to be home with your families or your business or whatever that may be. But always remember that for us, you know, information, you can get information anywhere. But although information is very important, education is most important, because at the end of the day, although Americans are more informed today than ever before, they're worse off than they've ever been, because information without education always leads to failure. And as I said at the very beginning of this webinar, my number one goal is to help you and your families change the way that you see things. Because when you start to change the way that you see things, the things that you see change. So again, thank you so very much for giving me a few minutes of your time, and I'll talk to you soon. Take care. Bye-bye.